Welcome to today's market update. I am Noah Dreyfus, CIO of Dreyfus Capital Management. We will be discussing today the markets in view of recent events and trends that investors should take note of. Keep in mind this is strictly a discussion of the economy and investment markets and is not to be taken as political commentary. This content is for informational and educational purposes only. It is not intended to meet the objectives or suitability of any specific investor, to give tax, legal, or accounting advice, or to be considered a solicitation for the purchase or sale of any security. Dreyfus Capital Management takes no responsibility in any action taken by investors on their own based on the information contained in this newsletter. In the last market update, the Hunger Games, an allusion to the fiscal austerity path that America had sought in electing the Trump administration, we noted as follows. It is important to note that no one calls the top, and only one trade marks the top of a market for an asset. In investing, the trend is your friend, and the general wise thing to do is to stay invested through market melt-ups because you never know when the market will actually top. Any trimming should happen at the margins to lock in gains, while a close eye should look out for formations of a top that is confirmed. Looking at the very short-term span of the 1 month, it seems that the market peaked on February 19th of 2025. However, Dreyfus Capital investors have been selling equity exposure throughout the month of February and into March, reducing our overall exposure to equities by over 10%. The first question most investors are probably asking is, why is the market selling off? The second question investors should be asking is, how much further do equity markets have to go before we find a bottom? Many of you remember being clients and investors back in 2022 when the Fed was raising interest rates and bond yields rose rapidly. Many of you also remember stocks falling rapidly, with the S&P 500 falling almost 25% by the end of 2022. Typically, stocks fall when interest rates and yields rise because the market is concerned about liquidity. Let's break down this concept into smaller pieces to understand. When interest rates rise, the risk-free rate of return rises. As you see here, interest rates were rising in 2022. This means that when interest rates rise, investors can seek a rate of return that beats inflation by buying a risk-free asset such as a US Treasury bond. For example, if inflation is 3% and Treasury bonds pay 4.5%, buying a bond will give the investor a real return of 1.5%, beating inflation. When the risk-free rate of return rises, investors are less incentivized to invest in risk assets like stocks because they have an alternative to get return through a Treasury bond. When the risk-free rate of return falls, conversely, and when interest rates fall, investors are more incentivized to invest in stocks. If so, then why would the stock market be falling when interest rates and the risk-free rate of return falls? To understand this, we must understand that interest rates for short-term loans typically follow Federal Reserve lending policy, but interest rates generally rise and fall based on the expectations of the economy by the market. As the economy expands and inflation rises, that generally means that interest rates will rise along with it. As the economy contracts and deflation happens, as prices come down, interest rates tend to fall. When inflation rises, bond yields or interest rates must rise to compensate bondholders for rising prices. Conversely, when the economy does poorly and contracts, interest rates generally fall to accommodate deflation and tighter spending. When inflation rises, bond yields or interest rates must rise to compensate bondholders for rising prices. Conversely, when the economy does poorly and contracts, and people spend less money, interest rates generally fall to accommodate deflation and tighter spending. In 2003, Warren Buffett wrote an article in Fortune magazine about the trade deficit. The article discusses that prior to 1970, the US had a trade surplus. Since we exported more than we consumed from other countries, we invested that surplus in other countries, gaining economic power worldwide. Since 1970, we have actually had a trade deficit, and countries have used their surpluses in trade with the US to buy assets in the US, reducing American economic power. Here's a quote from the article. Our annual trade deficit now exceeds 4% of GDP. Equally ominous, the rest of the world owns a staggering $2.5 trillion more of the US than we own of other countries. Some of this $2.5 trillion is invested in claims checks like US government bonds and private bonds, and some in such assets as property and equity securities. In effect, our country has been behaving like an extraordinarily rich family that possesses an immense farm. In order to consume 4% more than we produce, that's the trade deficit, we have day by day been both selling pieces of the farm and increasing the mortgage on what we still own. To put the $2.5 trillion of net foreign ownership in perspective, contrast it with the $12 trillion value of publicly owned US stocks, or the equal amount of US residential real estate, or what I would estimate as a grand total of $50 trillion in national wealth. Those comparisons show that what's already been transferred abroad is meaningful, in the area, for example, of 5% of our national wealth. Now, that article was written in 2003, 22 years ago. Since then, budget deficits have only grown, increasing the amount of ownership foreigners have in our country versus what we own still left of the farm. Tariffs can be an effective way of cutting foreign consumption by raising prices for foreign goods. Tariffs can also be an effective negotiation tool for trade, encouraging other countries who are reliant on the US to work on closing the trade deficit. This can serve as a tool for deflation, where other countries agree to consume more US domestic goods, thereby increasing the value of the US dollar. Simultaneously, other countries may agree to cut prices in order to increase demand and compensate for the tariff, devaluing their own currency. If the tariff is then removed, the net effect is that the dollar is consuming foreign goods, can consume more of those foreign goods, and the foreign goods being consumed sell for a cheaper price. The inflationary effect of tariffs is tariffs for tariffs' sake. If a trade war ensues from indiscriminate tariffs without proper good faith negotiation, then prices increase as the US cannot produce all the goods it consumes. Now, it would seem as though the Trump administration, to most people, is implementing tariffs for tariffs' sake. However, if the market is pricing in that as inflation, and inflation will increase because of tariffs, why would interest rates be falling? They should be rising. Thinking back to COVID-era fiscal policy, the reason inflation rose is that the government printed seemingly endless amount of stimulus in the form of money and gave it to people to spend. Because the supply of money rose, there was too much money chasing too few goods, and prices and thereby inflation rose. From a policy perspective, what is going on presently couldn't be further from 22. The Trump administration is cutting spending by eliminating government programs and jobs. It is also cutting contracts and reforming the procurement processes that ultimately pour money into the private sector. At the same time, it is hiking tariffs and increasing the price of imported goods, constricting consumption. Let's look at our diagram again. When we discuss that interest rates rise as a result of inflation, what we really mean is inflation in the money supply and the flow of money towards consumptions of goods and services. As that increases, interest rates rise. But when there's deflation in the money supply, meaning less goods are being consumed, less money is being spent, then interest rates fall. It would seem odd that the administration would come into power and immediately attempt to provoke a recession, especially for a president that has historically congratulated himself on rising stock markets. However, looking at this from a different perspective, the administration campaigned on a few select issues economically. First being reducing COVID-era inflation, solving trade imbalances, reducing or eliminating the US debt spiral, and restoring American economic supremacy. If one were to try and solve all four of the above issues with one economic policy, causing a short-lived recession would be the quickest and most efficient way to accomplish those goals. On March 6th, the Atlanta Fed forecasted GDP for 2025 at negative 2.4%, dropping from the 3 to 4% level GDP growth estimate they had given previously, forecasting an incoming US recession. As we discussed, a recession accomplishes deflation because as demand for goods goes down and less money is spent, prices fall. If a recession is caused in part by severe tariffs, consumption of foreign goods is more affected than domestic goods, potentially solving trade imbalances. If consumption of foreign goods falls more than consumption of domestic goods, the economies of countries reliant on the US consumer, for instance, emerging markets like China, fall more than the US, regaining economic supremacy in the long term. From a short-term perspective, the government under current interest rates is paying over $1 trillion in annual interest payments on the debt. The lower the interest rates go, the easier the hurdle the administration has in meeting its funding obligations. Looking at the US debt clock, you will see that we have a national debt of $36.5 trillion as of the recording of this video. So in effect, for every 1% interest rates fall, the government saves $365 billion in annual interest payments. During the first Trump administration with Treasury Secretary Steve Mnuchin, the refinancing of the US debt with 50 and 100-year bonds was explored. Unfortunately, this route was not taken by Secretary Mnuchin or Janet Yellen after him in the Biden administration. In fact, much to the opposite happened. Under Janet Yellen's supervision, the debt was refinanced into short-term bonds with short maturities, a year, 2 years, 3 years, 4 years, instead of long-term maturities, 5, 10, 20, and 30 years. And so what in effect happened is that over the course of the next few years, $10 trillion in US debt needs to be refinanced. Perhaps one could pose that the administration's strategy to deal with the debt issue is to get interest rates low enough to refinance the debt from short-term bonds into long-term bonds and allow inflation to offset the long-term costs of the debt. However, whether this strategy to cause a downturn in inflation or cause deflation is deliberate to refinance the debt or not, investors should not take this lightly. This causes a meaningful downturn in inflation and rates and will have collateral damage in the stock market and real estate markets. This would not be the time to rely on what worked for the past few years, which is owning real estate or the Magnificent Seven stocks. Let's take a look at some comments made by Chamath Palihapitiya, a famed investor.
We saw the world, and I frankly just agreed with everything that he was saying. So he probably can say better than I.
When you take a brew of tariffs, on top of that, we have slowing immigration. And in addition, now you have Doge. I mean, that's austerity. We think growth is going to slow to 1.5% from 2.5% in the second half. And so I'm actually pretty negative for the first time in a while. And it may only last a year or so, but it's definitely, I think the best gains have been had, and wouldn't surprise me to see a significant correction.
I think a couple of very specific thoughts. The first is that you're starting to see this compression of the Mag 7 towards everybody else. So this is the forward PE of these guys. And so what you're starting to see is everybody else starting to capture back some of the ground. People are processing what the real upside of the Mag 7 is. Now, if you go to the other chart, what this starts to show you, though, is that Mag 7 is really priced to perfection. And so you have to believe that the world kind of stays the way that it is. Otherwise, you're going to have some amount of mean reversion. So I think the stock market on the margin is a little expensive and not particularly that attractive. Second, the bond market has basically said, okay, we are going to give you credit that Doge is going to work and that tariffs are going to work. So we've had some pretty meaningful compression in the 10-year, which I think is really interesting. I think it's very good for Bessent and for Trump. And I think I've mentioned this before, but we got to go in and, refinance $10 trillion in the next 6 months.
So now that we understand that we are in a deflationary path with a potential recession or economic contraction on the way, how can investors hedge against this risk and position themselves in the market? Looking back on history, investing in the stock market is less about finding the individual stocks that will appreciate the most in any given time frame. It is more about following the supply and the flow of money. Hence the expression, the trend is your friend. Let's break down this concept more simply. As governments print more and more money over time, increasing the money supply, the primary job of an investor is to find secular trends of where that money flows. The secondary job is to identify and monitor the aggregate volume of money flow. We have identified already that the volume of money flow or monetary flow will decrease with public sector layoffs and fiscal policy contraction and tariffs. Since we know that the administration wants interest rates to fall, and as a result, economic activity will contract, we can now make a formula. When the volume of money contracts and rates fall, the value of the domestic currency contracts and the US dollar falls relative to other currencies. If investors in the US become fearful of a recession, and the fear of recession occurs at the same time that the value of the dollar is falling, investors will look for safe haven assets like gold to protect against currency devaluation. At the same time, when the domestic currency contracts, foreign currencies expand. If foreign imports in the US decrease due to foreign imports becoming more expensive, foreign governments will increase stimulus to their domestic economies to encourage consumption and maintain their economies domestically. At the same time that the US contracts its money supply, foreign governments are increasing the money supply. This allows us to follow the flow of money by buying foreign assets. Now that we have our thesis, let's look at how emerging market stocks have performed along with gold and silver. As you can see above, while so far this year the S&P 500 has had a negative return, emerging market stocks, gold and silver have had a positive return, with the emerging market general ETF rising about 6%, the China large cap stock ETF rising over 20%, and Brazil, as an example, rising above 10%. At the same time, gold and silver trusts are in the low 10% plus range in terms of return just so far this year. And as you can see, this is especially true regarding Chinese stocks. China has been managing its own economic recession for quite some time. Regarding its real estate issues, if investors can remember back to the Evergrande real estate collapse, and the crackdown on the tech industry, if investors can remember back to Jack Ma disappearing for a long period of time, the owner and CEO of Alibaba. This has led to years of stagnation and low valuations in the Chinese stock market. As a result of expected incoming tariffs, China recently instituted an unprecedented policy of fiscal stimulus to boost domestic consumption. Some investor takeaways. While action in the markets today and for the past few weeks have been quite volatile, the deliberate contraction in government spending, rising tariffs, and efforts to reduce long-term interest rates may be aimed at addressing larger issues like inflation, trade imbalances, and national debt. However, these measures also introduce significant risks of recession or deflation, and investors must navigate that carefully. In times of monetary contraction, shifting global trade dynamics, traditional investment strategies like investing in passive index funds may not apply. The flow of capital suggests that emerging markets, gold, and other safe haven assets could provide relative stability compared to U.S. equities. As always, staying ahead of market trends and adapting to evolving economic conditions will be key to preserving and growing wealth in the current environment. As always, today's content was for educational and informational purposes only. If you enjoyed today's content, please like, subscribe, and follow my page. All content displayed in any investment products discussed are not meant to be considered recommendations for any specific investor. Investors should properly weigh their risk tolerance with a licensed financial professional prior to making any investment decisions. Dreyfus Capital Management takes no responsibility in any action taken by investors based on the information discussed in this video. Thank you very much.